Good morning and welcome to Charting the Markets on Tuesday, the 7th of February. Overnight, the Reserve Bank of Australia hiked its rates by 25 basis points as expected to 3.35%. So that's the ninth hike in a row. But it also said that further rate hikes might be in the pipeline going forward. And this has had an effect on the Australian dollar, and we'll look at that later on. But let's begin, first of all, by looking at equity markets, because if you look at the FTSE 100 here on the daily chart, we can see that we've made a new record high last week on Friday, taking the FTSE 100 to 7,906, but here on the daily financial bet to 7,913. An all-time high, higher than the one seen in May of 2018. Now, what has happened since is that the FTSE, along with other indices worldwide, has come off on the much stronger than expected US non-farm payroll data, coming in at 517,000 and nearly beating estimates by 3 times as much. And basically, this has led to the Fed funds rates and also bank rates rising by about 10 basis points, and cuts not being expected before the end of 2023, beginning of 2024. And equity markets have come off on that, and so did the FTSE 100. But as you can see here, yesterday on Monday, we did hold and didn't form a bearish engulfing pattern. So it's not doom and gloom yet. But having said so, if we were to slide below yesterday's low at 7,807 on this daily financial bet, then the odds would be pretty high that we will at least form a short-term top and that the FTSE 100 could come back again towards its December to February uptrend line. And that would be around the 7,720 mark, next to which you can see the January low at 7,708. So yesterday's low at 7,807 is the one to watch out for, because if that gets broken through, then we could see some sideways to lower consolidation taking shape in the next few days. If we were to rise above the all-time high at 7,913 on the daily financial bet, though, the next upside target would be the psychological 8,000 mark. Moving on to the German market, what we can see here is that we also rose to a level last traded back in February of 2022, so just a year ago, at 15,553 on this daily financial bet, and have since then come off in 3 consecutive days. But you can see here that the drops are not particularly big. They're less than 1%. And we are currently bouncing off our 2023 support line again. So far, everything's looking all right, because we've got this really good support area here coming in between 15,272 and 221 on the daily financial bet. The highs going back to mid and late January. And as long as these hold together with the uptrend line, this might just be a short-term consolidation in a longer-term uptrend. Basically, from a longer-term perspective, the medium-term uptrend will remain valid as long as we stay above the mid-January low at 14,904. So as long as that support area here together with the late January low at 14,992 holds, the upside could still continue for the DAX 40 contracts. And if you go onto the weekly chart, we can see here that it is currently holding above this key support area going back to May 2021 and is looking still quite bullish on the weekly chart. And we could then extend all the way up to around 16,000 in the following weeks and month. But we'll have to see whether we are holding this week or not. Moving on to the US markets, what is interesting here is that they briefly rose above the resistance area I mentioned going back to mid-September, and also December of last year, between 4,139 and 55. And we did marginally close above 4,155 on Thursday, but then came off again. So that I wouldn't consider to be a valid breach of that resistance area. We haven't really come off far, though, and it'll be interesting to see what will happen today when Jerome Powell, the Fed chairman, speaks, and to see what he has to say with regards to the US Fed policy going forward. Because if the comments are quite dovish, which is probably not likely to be the case, then we could see a retest of this resistance area and perhaps it being broken through as well, in which case a rise above 4,195 on the daily financial band, the high seen last Thursday, a rise above there would basically take us back up towards the late August high at 4,215 and also the mid-August high at 4,325. So that's a possibility going forward. If Jerome Powell comes out with more hawkish comments, we might then slip back towards this breach downtrend line here and also the 2023 uptrend line, taking us back just to above the psychological 4,000 mark. The US dollar has also been impacted by the stronger than expected US employment data and basically has rallied quite strongly over the last few days. And we can see the inverse on the euro dollar chart, but I won't look at that straight away because I want to first of all start off with the Australian dollar versus the US dollar, because what we can see here on this daily chart is the impact this morning's Reserve Bank of Australia's rate hike by 25 basis points to 3.35% has had on the currency pair. Because as you can see here, the last few days we had a stronger dollar pushing the Aussie dollar exchange rate down to a 1 month low at 68.56. And then today we had this small bounce back towards 69.40 on the back of this rate hike by the Reserve Bank of Australia. So what we'll have to see here is whether we can manage to hold above the red line here, which is the 200-day simple moving average at 68.09, because a fall through it may lead to this previous sideways trading band being back in the picture, meaning that what we saw during much of November, December, basically the Australian dollar oscillating between $66.30 and $68.93, that then being retested, that sort of range, if we were to fall through the red line here, the 200-day simple moving average. Now, short term, we are bouncing off, as I said, but because of the downside momentum we've seen over the last previous 3 days, and that drop being quite sharp, the odds are that even if we were to rise, we might fail around the psychological 70 mark and then have another attempt to the downside. So short term, it looks as if further Aussie US dollar weakness may actually be seen. And this brings me on to the euro dollar, because as we can see here on the daily chart, it looks as if the uptrend that has been in place since September of last year is coming to an end, simply because we have topped out just above the 110 mark and are now at the bottom of the previous really important support area made up of mid-December, late December highs and also early January lows between 107.66 and 107.15. And if we were to close below 107.15 in the next few days on a daily closing basis, meaning a New York close really, a 5 p.m. close in New York, then the odds are pretty high that we may slip much further towards the next support area, taking us back to the mid-November high, the early December low, and also the early January lows between 104.84 and 104.44. So that would be our next support area in case of a drop below 107.15 being seen. But why do I believe that the current or the uptrends in September may be at risk here is because if you look at the longer term picture, we had for much of 2022, nearly all of 2022, this downtrend channel. And then since September, we managed to basically in October break through that downtrend channel and formed this uptrend channel. Now, as you can see here, we are now for the first time breaking out of that uptrend channel. And we also recently failed up psychological resistance around the 110 mark. And I wouldn't be surprised if we do see some consolidation take us back towards the 105 area, as I've just mentioned, on this currency pair. So watch out for that, because At the moment, it looks more like a case of selling into any rallies with regards to euro dollar than this being just another dip in a longer term uptrend. But we'll have to see in the days ahead. Moving on to euro sterling, and what has happened here is we thought we had a breakout to the upside above the previous mid-October to January resistance area between basically 88.67 and 88.97. And we did rally to 89.78, high last seen back in September of 2022. But now we're also coming off with regards to the British pound against the euro's coming off against the British pound. And we may retest basically that previous resistance area, now support area between 88.97 and 67. But that quite often happens when a trend break happens or when a break out of a range occurs. So that's not surprising. So basically, from a technical perspective, as long as we stay above the last reaction low, which is the low seen on the 30th of January at 87.63, this uptrend we've seen since December is very much intact and likely to continue in the days and weeks ahead. Commodity markets have also been quite volatile of late, with a lot of commodities coming off very sharply on this rising US dollar. And if we start off by looking at WTI on the crude contract here, what we can see is that we've had a quite impressive sell-off by several percent from the late January high, by about, as you can see here, 10% since then, and basically taking us back down again towards the January low and even slightly below there to $70.50 on this daily financial bet. And then over the last 2 days, we've had some upside momentum developing. And one reason for this was that over the weekend, the International Energy Agency, the IEA, Executive Director Fatih Birol said that China's economic recovery could be stronger than expected, which would boost oil imports by the world's largest importer of oil. And also on the back of supply constraints short term to do with the Turkish Seyhan oil terminal being shut down until the end of the week for precautionary measures because of the earthquake that has hit the region. And basically, this oil terminal exports about 1 million barrels of crude oil per day. So there's a short-term supply tightening being seen there, and that pushed the oil price higher with regards to WTI at the moment. But you can see here we still remain in a downtrend channel. And we really would have to take out Friday's high at $78.16 for a bullish reversal to take us back into this key resistance area I've been mentioning for the last few months now, made up of the mid-October low and all the highs seen since early December between $81.33 and $83.30. So that was the resistance area which capped us 2 weeks ago and which led to another downlight being seen. So the question really is, are we likely to hold now that we're bouncing back again in this $72.50 area and then heading back up again towards $81 to $83 zone and basically remain with this sideways trading band, or is this just a short-term blip in this recent downtrend, in which case a fall through the $72.50 mark would take us back down again towards the December low at $70.25 and perhaps even much lower, taking us back to levels seen in December of 2021 and towards the sort of $68 mark or not. So interesting times ahead with regards to the price of WTI. Gold is also very interesting because if you look at the daily chart of gold, as we can see here, we have very sharply come off our 9-month high at $1,959 per troy ounce, a level last traded back in April of 2022, and have that very quickly slid through this November to February uptrend line and accelerated all the way down to $1,862 on Friday of last week on the back of that stronger than expected US employment data, 517,000 new jobs being added, nearly triple as much as the forecasts were for the jobs creation in the US. And basically that led to the US dollar rising very rapidly as investors expected the Fed to continue to hike rates and probably more aggressively so than had been anticipated before the US unemployment data came out last week. And that then led to the stronger dollar, to the gold price coming off. And as I said, right now we're just hovering above the 1,862 dollar low we saw last week, and do so in very low volatility. And when that happens, quite often it means that the swift previous descent is likely to continue after a few days of sideways consolidation. But it will really depend on also what Jerome Powell has to say, the Fed chair, later today, with regards to the US Fed's interest rate policy going forward. Now, a slip below the $1,862 mark would take us back down again towards the mid-December high around to $1,825. So we've got some support here coming in that zone. So that would be the next downside target. And resistance at the moment can be seen between the mid-January low and also the late January lows. And those are between $1,897 and $1,899. So that's basically $1,900. That's the resistance area going forward. As long as we stay below there, further downside may be seen in the days ahead. Now, I'd like to finish up on aluminium because aluminium did hold last week at our $2,555 per metric ton support, and it bounced off it. But then, as you can see, we have had 5 consecutive days of lower prices taking us through that support, and we are now basically heading down towards the red line here, the 200-day simply moving average at 2,476. Once we fall through yesterday's low at 2,503. But here clearly we seem to be keeling over with regards to the price of aluminium, and this now heading back down again over the short term. Thank you very much for watching Charting Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.